Open on a trader who is not panicking. That is the dangerous part. The entry looks clean, the candle is green, the phone is glowing, and the account balance still looks normal. Then, one tiny decision changes everything. The stop moves, the size increases. A second trade becomes a rescue mission. By the time the trader realizes what happened, the market has not destroyed him. His own behavior has.
People repeat the line that 90% of retail traders lose money. The exact number changes by market, product, country, and time. In European CFD risk warnings, regulators have shown loss rates around 74 to 89%. So no, 90 is not a magic law of nature. It is a warning label. It tells you that retail trading is built on a battlefield where the average beginner is badly outmatched. Most beginners think they are trading against a chart. They are actually trading against costs, leverage, latency, professional liquidity, randomness, and their own nervous system. That is why this video is not about calling traders stupid. It is about opening the machine. Once you see the machine, the losses stop looking mysterious. They look engineered, predictable, and painfully avoidable. Imagine 100 new traders entering the market today. Every one of them believes they are different. They watched tutorials, saved setups, joined groups, and learned the words liquidity, imbalance, and confirmation. But the market does not grade vocabulary. It grades repeatable execution. After a few weeks, the group is already separating. Some lose because they are wrong. More lose because they are too big when they are wrong.
The screen makes trading look like a two-choice game. Up or down, buy or sell, green or red. But a real trade has more dimensions. Entry, stop, target, position size, spread, slippage, time of day, volatility, news risk, liquidity, and emotional state. A beginner asks, will price go up? A professional asks, if I am wrong 5 times in a row, do I still deserve to be in the game?
Before costs, every trade has a buyer and a seller. After costs, both sides pay the toll. Spread, commission, slippage, platform fees, financing, data, and sometimes taxes quietly drain the system. If you have no edge, costs accelerate the loss. If your edge is tiny, costs can erase it. This is why an account can bleed for weeks, while every individual trade still feels close. The worst losses often do not begin with one dramatic mistake. They begin with a leak. 10 low-quality trades a day, a little spread here, a little slippage there, a small revenge entry that almost worked. The trader says, I was close. But close is not a business model. Close plus costs equals a slow transfer from the impatient to the prepared. Leverage is where normal market movement becomes emotional violence. Without leverage, a 1% move is a 1% move. With 10 times leverage, the same movement feels like 10% on your account. With 20 times leverage, ordinary noise can become a crisis. The trader stops reading information and starts defending identity. Here is the math people avoid. Risk 10% per trade, lose 5 times in a row, and the account is almost cut in half. Now recovery becomes brutally harder. A 10% drawdown needs about 11% to recover. A 50% drawdown needs 100%. The market does not need to beat you forever. It only needs to beat you while you are oversized. The third ugly truth is that most traders confuse a setup with an edge. A setup is something that looks good on a chart. An edge is a measured advantage after costs across enough trades with rules that survive execution. A screenshot is not an edge. A pattern name is not an edge. 3 winning trades are not an edge. A strategy becomes real only after the sample is large enough to hurt your ego. The human brain is a brilliant pattern machine and a terrible probability machine.
If price bounces twice from a level, we see a law. If a candle rejects a zone, we see intention. If an indicator crosses and price runs, we see proof. Sometimes the pattern matters. Sometimes it is just noise arranged in a way your brain wants to believe. Professional traders are not emotionless machines. They are people who build guardrails before emotion arrives. Risk limits, predefined invalidation, session loss limits, journals, post-trade review, separate research from execution. Retail traders often do the opposite. They research while in the trade, move the plan while the candle is moving, and call emotion discretion.
The fourth ugly truth is the disposition effect. Traders tend to sell winners too early and hold losers too long. A winning trade gives relief, so profit is grabbed before it disappears. A losing trade gives pain, so the loss is delayed. The result is many small green wins, a few huge red losses, and an equity curve that looks confused until you inspect the average win and average loss.
This is why win rate can become a vanity metric. A trader can win 70% of trades and still lose money if the average loss is much larger than the average win. Another trader can win 40% and make money if winners are larger than losers. The market does not pay you for being right often. It pays you for being right with asymmetry. Now add social media. It rewards screenshots, not process. It rewards huge percentage gains, not risk-adjusted returns. It rewards confidence, not sample size. Nobody goes viral for saying, "I followed my plan and took a small, controlled loss." But that boring sentence is closer to professional trading than most of the profit posts that pull beginners into bad risk. Attention itself becomes a cost. Retail traders watch every tick, and every tick becomes a vote on self-worth. Green candle? Genius. Red candle? Idiot. This emotional feedback loop creates overtrading. The trader begins the session looking for the best trade and ends the session looking for any trade that can repair the feeling. One of the most dangerous moments is the revenge trade. The trader loses on a valid setup. Pain rises. The brain wants the pain removed. So the next trade is not analysis anymore. It is a negotiation with the previous loss. Size increases, rules soften, confirmation becomes selective, and the trader demands emotional reimbursement from a market that owes nothing. Markets do not need a conspiracy to punish retail traders. Predictable behavior is enough. Stops cluster around obvious highs and lows. Breakouts attract late entries. Sharp reversals punish traders who entered after the easy move was already gone. Fear and greed are stable, and that stability creates liquidity. The trap is not that the market knows you. The trap is that many traders behave the same way.
The sixth ugly truth is that many traders use a time frame that does not match their life. Scalping while distracted, swing trading while checking every 5 minutes, trading news without understanding volatility, holding overnight risk with intraday conviction. A strategy can fail not because the idea is useless, but because the trader cannot execute the behavior that the idea requires. Beginners search for the perfect indicator, the perfect entry, the perfect signal. Professionals obsess over invalidation, sizing, execution quality, and review. The entry is only one part of the trade. The exit and size decide whether a good idea becomes a good outcome. Most traders are not missing one secret indicator. They are missing a system that prevents one bad impulse from becoming an account event. Every trade can be reduced to 4 numbers: probability of win, average win, probability of loss, and average loss. Then subtract costs. That is expectancy. If expectancy is negative, discipline only loses money more consistently. If expectancy is positive but position sizing is reckless, variance can still destroy you. Edge without survival is only a theory. So the real question is not, does this setup work?
The question is, what is the expectancy after costs across enough trades through different market regimes executed by me under pressure? That last phrase matters. The market does not test your spreadsheet. It tests your nervous system when the plan is easy to understand and hard to follow.
The eighth ugly truth is that many traders treat trading like income before it has proven itself as a business. A business has capital requirements, operating costs, records, controls, bad months, and review cycles. A fantasy has a profit target and a calculator. Turning a small account into a salary quickly usually requires leverage, frequency, or oversized risk. Those are exactly the tools that shorten survival. Account size matters because pressure changes decisions. If the account is $500 and the trader wants $200 a week, the required return is extreme. The goal itself becomes the trap. The market does not care about rent, bills, pride, or urgency. When the need for income is larger than the account can support, risk discipline starts under attack before the first trade.
Being smart is not enough. Intelligence can become a liability when it creates sophisticated excuses. A smart trader can explain why the stop should move, why this loss is different, and why a new indicator confirms the impulse they already wanted to take. Trading is a feedback game, not an IQ contest. Hypothesis, test, measure, update, and protect capital while learning.
So what does the minority do differently? They make the game smaller and more boring. One market, one setup, defined risk before entry, clear invalidation, small enough size to survive a losing streak, journaled execution, review separated from ego. They do not try to feel like great traders every day. They try to become difficult to exploit. After each trade, the useful questions are simple and uncomfortable. Did I follow the plan? Was the setup actually present? Was size correct? Did I move the stop? Did I take profit because the plan said so, or because fear said so? Did I enter because there was edge, or because I wanted action? The answers reveal whether the problem is strategy, risk, or psychology. When you hear that 90% of retail traders lose money, do not treat it as a curse. Treat it as a warning label. Most people lose because they enter a professional arena with amateur risk, emotional execution, and unrealistic expectations. The way out is not hype. It is evidence, patience, sizing, review, and humility. The market does not need to hate you. It only needs you unprepared. Your job is to become harder to exploit.